Welcome everybody to the Wednesday free webinars. We talk about the market, a lot going on, or potentially could be going on this week. What are the big earnings stocks this week? What do we have? Tonight after the close, which we might look at, I believe Tesla and Microsoft will be reporting earnings after the close of trading tonight. And then I believe Amazon will be reporting earnings tomorrow after the close. So those are three catalysts. A few of those have quite a bit of percentage of the SPX, right? Some bigger members. And then next week, both barrels of the shotgun will be next week. You have Apple, Google, Facebook, and Starbucks isn't as big as them, but I just wrote that down there. But Apple, Google, Facebook will be week, as well as the open market committee meeting next week. So some things for potential fireworks. Any big stocks or news I mentioned for this week or next week? All right, well, let's jump in today and let's take a look at the market and see what we have here. All right, so what do we have here? Again, we're taking a 30,000 feet up in the airplane view on the market before we look at opportunities, right? Probably good to see when you leave your house in the morning, you're probably aware of the weather, right? You don't just put on clothes and go out. You say, okay, what's the weather outside? Right? It's going to determine what you wear. It's going to determine your driving and many other things. So as we look at the last 3 months, I think it's important to focus on that. If you look at the last 3 months, what are we looking at, right? We're looking at a SPX of around 28.25 to this kind of 30-20 near the highs. So that's kind of a range of SPX. Where are we now? 29.97. So we're knocking on the door of the all-time highs in the history of civilization as we know it, right? Perspective. So we're talking about the weather before we jump into strategies. Second, what are we looking at? The VIX. So I'm not even getting into strategies yet, right? You can't wake up and just yell, Iron Condor! No, you hold on here. What's going on? Let's get some structure here, then let's look for opportunities. The VIX is 14.25. The range over the last 3 months, right, is about 13.5, roughly, to 21, roughly. So we're in the high end of the range, price-wise. We're in the low end of the VIX. And then one other thing I'll look at just for now will be the ATR. It's the average true range. Again, what am I looking at? Before we get into strategies, before we get into all this nonsense, let's take a peek outside and see what the weather is. It's going to determine what car I take, how fast I drive, what clothes I wear, the whole 9 yards. ATR. And SPX about 25, and you can see that's kind of at the low end of the range over the last couple months. So that's low. So, and again, for those of you maybe you weren't here last Wednesday, I think most of you know what SPX is, right? It's an index made up of 500 stocks. It's a diversified index. Most of you know what VIX is, kind of a gauge of the fear index, they call it. Gauges the volatility of the market, and an ATR is just simply measuring, when you look at a price chart, these individual candles how wide the range is between the high and the low of SPX. The last week or two, market's been more quiet, and so the range between the high and the low might be 15 to 30 points a day. That's easy peasy, right? When we were back in August, when things were cutting loose, the range between the high and the low of SPX might be 50, 60, 70 points in a day. So ATR is more something we look at when we're looking at short-term trades, 7 to 15 days, to let you know how much turbulence there's going to be. And when the ATR is low, what you find a lot of times is, if any of you have done over the last week or two 7 to 15 day trades, like an iron condor, butterfly, calendar, those type of things, how have they worked out? What do you think? I know the answer because I've been doing them, but I want to see, what do you guys think in the last week or two? If you look at how the market's been the last week, Tanya said fine. I'm going to use a word that Carolyn used from my favorite movie. One of my favorite movies is Charlotte's Web, right? And in Charlotte's Web, Charlotte's Web has didn't Charlotte write? Did she write excellent, terrific, whatever? Terrific. 2 movies I can admit to you, if you don't tell anybody, 2 movies that I have cried in my life. There's probably more, but only 2 that I can remember. Charlotte's Web, and Brian's Song. Do you remember Brian's Song? Story about a football player, Gale Sayers, and Brian Piccolo? Whatever. But Charlotte's Web, when Charlotte died, right, and that relationship with Wilbur was going to be severed, tore me up, right? Anyways, now that I have that confession out of the way, so the ATR is more affects short-term trades, and it's been very smooth. Not a lot of turbulence in the air the last week and a half, and so short-term trades have gone well. So we look at these measurements, and so, and one other thing. If you look at the SPX, unlike the RUT, we're above the 50 and the 200 day, so we're in an uptrend, right? Whether you think we're going down or up, who cares, right? Whether I think it's going, it's easy to say 20-some points from the high, we're going to go down. We're going to go up, we're going to go down, who knows? But the reality is we are in an uptrend. The reality is we are above the 50 and the 200. The reality is VIX is kind of on the low end of the range, even though it's come up the last few days. It's in the low end of the range over the last 3 months. The reality is the ATR, the distance between the high and the low in SPX is low, so range-bound trades have been doing pretty good. And the reality is we're near the highs. Okay, so based on that, what would I look at? One other thing, just to give, I'm giving you a 30,000 feet up in the airplane before we get into strategies, because again, you don't just wake up and grunt. You wake up, covered right, put credit spread, long call. No, you don't scream like that. There's got to be some structure, right? Right? This is a business. This is a craft. When I was in the pit, I didn't wake up and just say, covered right. No, I didn't yell that out. I would have got fired, right? We said, hey, what's going on? Where's the opportunities? Blah, 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 right? So now that we got a little bit of what's going on, now, where does all the trades that you guys do, where do they fit in, right? And real quick, most of you know this, but I put everything in the 3 boots. Boot number 1, long portfolio. Boot number 2, income portfolio. Boot number 3, spec. So basically what I'm describing to you is kind of how we look at the world here at Sheridan Mentoring, how we trade, right? Most of you are probably in the world of options. 90% of the world in options education, even with most brokerage firms, is they start with, to me, the downfall of all of your trading. They start with an opinion. Robert or Gary or Art, dear, what's your opinion? Right? If you call TD Ameritrade or any of these brokers, well, what's your opinion, sir? If you call one of their advisors, and you'll say, I think the market's going up. Okay, since you think the market's going up, here's a couple things you can do. Maybe based on the volatility, they give you some nice things. But to me, I don't want any part of that for the most part. If you're going to make your living based on your opinion, oh my goodness, that's a tough one, right? Especially if your opinion is which way the market is going up, is going over the next 3 weeks or a month or something. Now, if you say, hey, I like Apple over the next 2 years, that's a different discussion. So long portfolio, you take the view of an investor. Those are strategies like covered rights, cash secured puts, long diagonals, put credit spreads, many broken wing butterflies that we talk of because they have very little risk on the upside. But that's the view of an investor a little longer term. So those are intentionally neutral to bullish positions. And right now, on a hypothetical $5,000, $10,000, or $100,000 portfolio, are we consistently doing these consistent strategies every week or month? Yeah, but on a hypothetical portfolio, I might only put 25% into these type of strategies right now. So I'm still doing them, but lower my percentage. Why? Same reason. If somebody called you up on the phone and said, Gary or Robert or Art, I'm with TD Ameritrade. I had a revelation in the night after I had a lot of pizza. We're at the all-time highs. Now is the time to get long. Get long. What would you say? What would you say? What would you say if some brilliant rep from one of the brokerage firms said, hey, I want you to get long at this point. Get 100% long. You're right, you'd hang the phone up. So what I'm saying is near all-time highs, it'd be 25%. If they called me up on Christmas Eve of 2018 with SPX 25% off the highs, then we were about 60%, right? If you're a long-term investor and you talk to me when the market's off 20%, that's a deal, right? If you're a long-term investor. So that's where we are now. Income portfolio, we're probably around 45%, right? Right? As long as we like VIX between 12 and 18, ATR under 27, those are good flying conditions if you're a pilot, right? And we are right now. So it'd be about 45%. These would be range-bound strategies relying on probability and decay like butterflies, iron condors, calendars, double diagonals. And then spec is Patricia or Art or Gary wake up in the morning and they say, I have an opinion based on fundamentals, based on technicals, Fibonacci's, Habanero, whatever, dreams, whatever. I think this, right? I think we're going down. Or maybe, you hear a lot about unusual option volume, right? That's going to tell you, right? But based on any of these things, you make an opinion. And you express that opinion in strategies. You can buy a call or buy a vertical. Call vertical if you're bullish. You can buy a put or a put vertical if you're bearish. You can buy a bullish calendar or a bearish calendar, by a bullish or bearish butterfly, many different ways to express your opinion. But spec is based on an opinion, income is based on probabilities and K range bound, long portfolio is based on the view of an investor, like you guys on your retirement account. John Dory says, that's your former employer talking about unusual options. But John and Pete and Jerry, and good friends of mine, yeah, they do unusual option volume. I think they're better than most. All I'm saying is unusual. I'm not saying anything about Pete or John, but I'm saying about, when you're looking at unusual option volume, I mean, it could, again, part of it is if I talk about unusual, put it this way. When you wake up in the morning, you like to see, how many of you like to see what's going to be the big movers for the day, right? How many of you like to know which stocks are in the spotlight, right? Which stocks are in the spotlight, which stocks are movers and shakers, right? Now, for the spec portfolio, you could look at that. I usually stay away from that like a plague, right? Why do I want to walk, right? I mean, it's speculative. Agree, we'll just leave it at that. But that's not where I look for opportunities, right? If they said, hey, Dan, the West Side is, my daughter works for in Greenville, South Carolina. She's a reporter for the newspaper there. Well, so they look for action every day. But as a trader, is that usually where my opportunities are, where the action is? As Sylvester Stallone says, absolutely not. But that's where you guys have interest in. That's the spec part of the portfolio. But do I look at that for most of my income for the year? Absolutely not. But it's what you're interested in, right? But I'm not interested in it for the most part. Anyways, so that's kind of where we put all this stuff together, right? So how I look at the world now. So based on where the market is now, right, for the income, we'll stay away from just a second the spec part of the portfolio, which is we can, we don't have enough time to go over a trade for each part of the portfolio, but I'll just tell you for the long part of the portfolio, we might be looking at SPX put credit spreads, again, covered rights or long diagonals in stocks you like, all of that, right? But I would be less size than normal, right? If I normally do 5 covered rights, I might do 2. If I normally do 6 put credit spreads, I might do 2. Why? We're knocking on the door of the all-time highs. I'd be a little bit off, cash off the table. In terms of spec trades, I'd look at earnings opportunities, but I look at those as spec trades. The fact that you use an iron condor for an earnings situation is just saying you think the expectations are going to be less than what the market maker move is, and so you do an iron condor. But it's like in Chicago using a baseball bat outside of its original purpose of playing baseball. In Chicago, they use baseball bats to beat each other, right? So it's just like using an iron condor around earnings doesn't make it a safe trade, but it's different me doing an iron condor in SPX, which I may look at today, versus doing an iron condor in Tesla tonight before earnings. Do you understand how those are two different strategies? Yes, please say yes. Yeah, don't think because you're using the word iron condor, they're same. They're totally different. So I'm just going to focus on the income part of the portfolio with the little bit of time we have left. And I'm going to look at a trade that I may look at today. Again, with the VIX in the low end of the range over the last 3 months, 14-ish, I'm not really interested for short Vega trade strategies that would benefit if the volatility goes down. I'm not looking for to go much further out duration just because the volatilities are lower. So I may go, if I'm going to do a short Vega trade, just because I think the last couple of Wednesdays we've talked long Vega, haven't we? If I did short Vega, I might go a little bit shorter term. maybe 15 days or something or less. So maybe today, who remembers what trade we put on last week or what type of strategy? I'm just trying to give you a little bit of variety. We didn't do an iron condor, did we? Anybody remember? I don't remember. I surely don't remember. I'll do an iron condor. So this is how I do an iron condor. Again, I might look. Now we're moving next week. We're moving to. Did we do a butterfly last week? Maybe I'll do long vega. Maybe I'll do a calendar. Maybe I'm switching right now. I'm going to be out of. Here's an important. We're moving. We're leaving the cold Chicago. We're moving to Greenville, South Carolina next week for the near-term future. And so I will be out there. And because we're moving Wednesday, Thursday, and Friday next week, if you've ever moved, we'll be out of whack, right? So I'm trying to make sure all my trades are off Tuesday at the end of trading. So let's go look at a calendar. I'm going to look at a 9-day calendar. Expires on a Friday, a week from this coming Friday. I'm going to go calendar. Vols are relatively low. So the income part of the portfolio, do you understand? So I'm not just, and we should have, whether I'm trading a 10 grand account or 20 grand or 100,000 or 2 grand account, I'm kind of using the allocation. I'm putting my capital. So I know what I'm trading, right? It's not like I wake up and I need Jim Cramer or I need something to tell me what to look at, right? So I'm going to put a calendar on. I'll put one on live. So I'm going to put buy calendar. I'll just put one here. I'm going to sell. I'm going to do the 9-day calendar. I mean, the ranges in the SPX have been quieting down, so I'll try to do this. I mean, obviously, one of my concerns is next week. What do we have going on next week news-wise? What do we have next week news-wise? That could provide some bumpiness here. FOMC meeting next week, right? So that could cause some problems for this. My goal is if I put this on today, Wednesday, I'd like to be out by Friday or Monday. So if I put this on today, my goal on a 9-day trade is to be out in maybe a third of the duration. So Friday or Monday, I'm out, right? Tuesday's my last day trading, so it's going to be off by then. So I'm not going to be going into the Fed meeting, but it might hold up some of the profits here by keeping the volatility up. But I think I'll be able to get out by Friday or Monday. Now, again, the biggest obstacle for a 9-day calendar is going to be price movement, isn't it? So let's go in here and look at this. I'm going to sell the Nov 1. I'm just going to do a 1-weeker. Sell the Nov 1 by the November 8. Okay. And do it at the money in the call. So at the money would be like $29.95. And this is what she looks like. So Dan, what is it? What are you doing? Work with me. I'm using the income part of the portfolio. And because volatilities are kind of on the low end of the last 3 months, I'm putting on a calendar here. Most of the time, we're putting on similar trades every week or month, but we may tweak them based on volatility, ATR, market, price movement. So I'm buying 1, selling 1. I'm buying the Nov 8. I'm selling the Nov 1. $29.95 call. Why am I doing that? At the money. Why at the money? That's where the most time decay is. And it's going for around, price is changing, around 630 debit. So one contract could cost 630. Price of the underlying is around $29.95. This is your expiration graph, what this looks like in 9 days, a week from Friday. The red line is what the graph looks like today. That's the reality of the trade, right? Over time, this graph will morph into the green graph, right? So it's looking for about $6.30 debit. How do you make money in a calendar? Again, the short option we're selling is going to decay a lot quicker than the one I'm buying. So if we were to close at the short strike at $29.95 a week from Friday in 9 days, that's the expiration of the short. The expiration of the long is 16 days. But just hypothetically, if we closed at the short strike in 9 days at expiration, what we sold this for would go to zero. This would still hold value, right? Let's say that we close right at $29.95. This would close at zero, and this would still hold some value, right? If we closed right at the strike in 9 days, the November 8th might be trading at, I'm just making this up, $10. So the spread would go from $6.30 to $10, right? Right, or more, right? So your short would go to zero. Your long is still going to hold value. That's how you make money on the decay of your shorts over time, and it's expressed in this thing, decay. Theoretically, if you look at how each of these two options decay, theoretically it says we're going to decay at about, we're going to make about 27 bucks a day on this $630 investment. And this number will grow every day as we get closer to expiration. This Vega says that the volatility of each of these two options, and this is what they are right now, if they each go up a point, right, I'd make around $60 theoretically. And that's because I'm buying more extrinsic value in my long than I'm selling. So if just the volatilities go up a point, I'd make $59. Conversely, if the volatilities go down a point in each of these two options, I would lose $59. So generally, I buy a calendar when I think the volatility is in the low end of the range and might work its way up maybe towards the mean, right? You have two risks in a calendar, price and volatility. So if I buy this for $6.30, and I watch the mid for a little bit, right? I'm watching this mid for a little bit, 630. Get an idea where it's moving for, 630, 635, and let's buy this. And you could see, right click at 630, and you can see here, my commissions would be, what are commissions? TD Ameritrade, $1.30. So our commission's free. Now, what's interesting is, just like in all advertising, right? Free can mean anything. Free could mean I'm going to charge Rich Cardarelli 0 commissions, but he's going to have to buy me Italian beef sandwiches the rest of my life. So free to think to TD Ameritrade in SPX is 65 cents a contract, right? So zero, as Scott says, zero is in your mind, right? Zero is in your mind. When Scott lays in his bed at night, he thinks, free. And he looks at his commissions, it's not free, right? Fees, okay. So what's the correct word? Is that honest advertising? Right? Right. So if I'm gonna, right? It's using the English. To me, call it fees, commissions, call it boogly hoogly or oogly oogly. What do you call it? Right? Commissions, fees. What's the difference? Right? What options? Bottom line at TD Ameritrade, you're paying 65 cents a contract, whether you do stock or options. Agree? Boom. Now, after doing that, let me be honest with you. Is 65 cents a contract good? Yes or no? Is 65 cents a contract good? Yes. What do you think option contracts were 30 years ago? Anyone want to take a guess per contract about 30 years ago? And you trading options 20 years ago. What were options commissions 20 years ago? $5, $10 a contract? This is great. But we still got a problem. Right? What's the problem? Even if they made your brokerage commissions free and sent you breakfast every day and painted your toes for you and rubbed your belly, still got a problem? What's the problem? What's the problem? What's the problem? What's the problem? All right. I'm TD Ameritrade. I'm going to give you free options contract, free everything. You don't pay anything. You still got to know how to make money, right? You still have to know how to run an options business and make money. Yes? Somebody say yes. That's the problem I always see, right? Right? It's really, all those things are good, but if you don't know what you're doing and you're not consistent and know how to run a business, who gives a hoot, right? Anyways, that's my 2 cents. All right, so what am I paying here? We're at, let me make sure, because I was blabbing on and on. We're at $29.95. Let me make sure it's around $6.30. All right, I'm going to go in at $6.30. So I try to pay $6.30. You with me? All right, so let's just take a look here. I'm paying $6.30. The mid price is $6.30 to $6.35. They're asking me to pay another nickel, right? I might wait, but and we're at $29.96 in SPX. The strike is $29.95. Let me ask you a question. Do you pay more for a calendar? A, as we move away from the strike, or B, as we move towards the strike? Do you pay more for a calendar as we A, move away from the strike, or B, move towards the strike? The answer is B, as we move towards the strike. So as long as we're around $29.95, all right, I'd like to pay $6.30. If we move to $29.97, $29.98, 3 points up. If we move to $29.92, 3 points down, away from the strike, I might want to cancel replace and pay less. You get that? You pay more as it goes towards the strike, less as it goes away. So I don't just let it sit there. If we start moving away from the strike one way or the other, I might pay less for this. Or I might change my strike price if we change far enough. All right? So that's why I'm probably going to have to pay up a nickel, because we're right at the strike right now, if I wanted to do it now. So let's go to 635. And I got filled, right? So that's, right now, that's kind of the going rate if you're going to go buy cookies, right? If you're going to buy these, with the price around $29.94, pay $6.35. All right. If you want, you know what I'll do? Just for time purposes, I got to run here, but I want to show you something, but if you just go to Sheridan Mentoring, the front page, check blog. I'll try to update this, what my plan is over the next week, and then we'll go from, I'll put the plan up. I want to show you something real quick here, a new program we are excited about. It's Sheridan Mentoring, to make it more accessible, make Sheridan Mentoring more accessible to the masses, right? And something you can look at. 3 new programs are starting November 11th. We're excited about that. We're testing it now, and November 11th will be the launch. You have your basic package, and basically you get, for your basic package, you get an opening bell and a trader's lounge. As you scroll down on this, there'll be a FAQ, and you get a little more on this. But basically what it is sessions done by myself, Mark Fenton, Jay Bailey, where we'll be doing teaching, looking for trading opportunities, assessing the market, teaching you. So it won't just be, we will be giving, doing quite a few trades, mostly live trades, but we're looking to show you how to do this, right? And so they'll be teaching. It'll be a great opportunity for you to come into Sheridan Mentoring for the first time in 15 years. I think we're just making it more accessible for you to come into. And so these would be probably 2.5 hours at least a day of good, clear trading help, info, opportunities. And as I said, most of the stuff will be live, so you'll see it, but teaching you how to do this. The first month is probably the thing you might want to do, would be $49. You can try it, and it goes to $125 monthly if you want to just do monthly, right? So the first month, $49, you just click on this, and that'll get you in the trial starting November 11th. You get the first month. What we do here, I never liked, I don't know about you guys, we do things a little different here. We always have. I'm a little different, to say the least. But usually when you do something for a month, what's the way people do business in the United States? They turn it into a subscription model. And I know if you're anything like me, I'll get a Wall Street Journal, I'll get it at the lower rate, then it goes at a higher, and I forgot I did it, and 8 months later, my wife's like, what are you paying this for? I don't know. How many of you like that subscription model stuff? I guess there's some good to it, but what we do it a little differently. The first month, you pay $49. The second month, we don't just hit your credit card, right? We'd reach out to you like a human being, see how you're doing, see if you have any comments, see what's best for you. If you want to do it, then we'll do it. Not hitting the credit card. I never liked that as an individual. I know people would say, well, that's smart business. Again, we care about the individual. So anyways, that's what we're doing here. If you want to do any of these on a yearly basis, we give you 25% off if you just do it the first time. But I would recommend for the first month, $49, come and see what we do, what we've been doing for 15 years, right? The only difference in the packages is you get to like Basic Plus, you'll get the current online class. So every month you'll get an online class that we do, which is usually 3 weeks, twice a week. We've been doing this for probably 8 years. And in the ultimate package, you get a 1-hour one-on-one session with myself or one of my guys, and you get as a bonus, we have trading groups. Each of the mentors runs a half-hour to hour trading group meeting every week. So anyway, something to look at. Again, for the first month, $49. Again, it doesn't auto nail your credit card. I think this would be a wonderful opportunity to learn the business the right way. We've been teaching people to trade for 15 years. And I think this will be a wonderful opportunity to jump in. So any questions on this, I think as you scroll down here, if you do have any questions, there's Q&A, there's live chat, there's an 800 number, you get some FAQs, any questions, but we're excited to launch that. Tell your friends November, what do we put there? 11th. So folks, have a great day. We will see you, you know what, next Wednesday we will not be doing this because I will be moving. I'll be driving the big 26-foot truck. But we will be back a week from next Wednesday. And thank you, David. Yeah, we have a couple girls in South Carolina. We'll be Greenville, South Carolina, home of Clemson football. And we have a couple girls that live out there, so we'll be hanging out with them for a while. All right, folks, have a wonderful day. Thank you.